Speaking of preferred return, this is something that we're going back and forth on, is as you start doing deals, you realize that preferred returns can also really inhibit a deal from being a long-term hold, right? Because there's that catch-up period and I don't feel like it aligns with a longer hold. What is there any inkling on changing? I know some operators have gotten rid of it completely. What do you take to preferred returns?
Yeah, we actually got rid of them completely a few years ago because contrary to popular belief, preferred returns actually put the interests of the LP investors in opposition to the interest of the sponsor. And so you have a conflict of interest there that generally will make the sponsor can push the sponsor to make decisions that are not good for the investment of the property. And again, Brian actually addresses this thoroughly in that book. There's more on it in there. But basically what happens is, think of whatever that hurdle is. Typically, a preferred return is based on an internal rate, a hurdle of, 7% or whatever. And it's based on the IRR, internal rate of return. So the question you got to ask is, well, how can IRR be manipulated by a sponsor? They can get really high leverage. What does that do? That increases risk. They can refinance or sell early. That increases the IRR. So that's part of why you saw so many 2 and 3 year deals the last few years, is because the quicker you sell, the easier it is to hit the IRR. It doesn't mean your total return is actually that good. It just makes the IRR better. The reason being is that IRR factors in the time value of money. So the quicker you get paid, the higher the IRR. Again, doesn't mean you're getting paid more. It's just that IRR number goes up. And that's always the metric it's based on. So internal rate of return can incentivize the sponsor to, over leverage, sell when they shouldn't, refinance when they shouldn't. And then also, this didn't happen too often in the last 10 years because we were in a raging bull market and everything went great. However, let's say you've got a 7% return and we get into, a market like today where the interest rates goes up. Now the mortgage is higher, or maybe the rent's not increasing as much. And so now the property can't pay the preferred return. So let's say it's still doing okay and that property can pay 6%, but the preferred return is 7%. So what does that mean? That means the sponsor is no longer getting paid. So now you run into the situation of, okay, is your sponsor strong enough financially to continue to operate if they're not getting paid? Now, if it's one deal out of 10, yeah, they should, hopefully they are. But what happens if all 10 of their deals have preferred returns and the market has shifted like this, and now they're not getting paid on all 10? Do they have the financial wherewithal to continue operating and managing those deals? Let's say they do. Let's say they have the financial ability. Is that sponsor going to be willing to continue to operate those deals and not get paid for the next 2, 3, 4, 5 years, right? That hasn't happened. That wasn't really a concern, or nobody thought of that when rents were going up 8% a year for the last 7 years or whatever it was. But that's what's happening now, is a lot of these properties can't meet the preferred return, and all of a sudden the sponsor's not getting paid. And sponsor has to keep the lights on, right? So the question becomes, okay, if your sponsor is not getting paid, how good of a job are they going to be doing running that deal for you? So those are just some of the ways preferred returns actually put LPs and sponsors' interests at odds with each other and can really cause problems, especially in anything that is not a raging bull market.
And those are my feelings exactly, because it's 1 percentage point you fall behind a quarter and it starts looking like you can't get ahead of it type of situation. So that's where we've been heading towards, because we don't want to do 1,000 deals, but we want to do a few deals and hold on to them for a really long time. And that's exactly why we're thinking of also getting rid of preferred returns on future deals.
Yeah, there's some LPs out there. It seems less and less, thankfully, but there's some LPs that, and it's actually more on the institutional side, that almost approach the sponsor LP investor relationship adversarially. Hey, I'm giving you money and you better pay me first and all this. You shouldn't be investing then if that's your approach. Your sponsor is your partner, and it's literally limited partner, general partner. The two of you and whoever else is involved are partners in the deal. You want to approach it with that mindset. Your sponsor should never be coming to this with a mindset of taking advantage of investors or anything but serving investors. And then investors should be approaching it like, okay, I am partnering with this person or this person's team for the next 5 years in this deal. We want to make sure that we win together, not just one of us. You don't want the sponsor to collect a bunch of fees and the investors make nothing, but you also don't want the investors to make everything and the sponsor gets nothing. Either one of those situations is unbalanced, is going to cause problems.
Yeah. And, as silly as it is, I still meet investors that confuse preferred return with cash on cash all the time.
That's another one. Yeah. Preferred return doesn't mean you're going to actually get it.
Yeah. It's just a benchmark. That's it.
Yeah.
Yeah. So that's something like when I talk to people and they're like, oh, I think our last deal preferred return 6. And then you have to like actually go in and actually explain to them that's not actually your distributions. And then that's why you can't compare it with someone else out there that has a preferred of 8, 9, whatever it is. It's not apples to apples. So the other thing, I think I should actually, you know what? We only have about 10 minutes left. So let me open it up